joined with Faisal Nassar, Chief Executive Officer, Ziad Al-Dahami, Head of Treasury and Investor Relations, and Assam Al-Mashloom, VP of Finance. The company, as usual, will start with a brief presentation and then we'll open the floor for Q&A. Ziad, please go ahead.
Thank you, Ahmed, and good afternoon, ladies and gentlemen, and welcome to our call today for Dr. Sulaiman Habib Medical Services Group, which will cover the update for Q2 2025. Also, we extend our appreciation to AFG Herb's team for hosting the call today. The financial results for Q2 2025 were officially disclosed on 27th of July and are accessible on both the Dow website and our IR webpage. Please allow me, before we begin our call today, to remind you that we, as a listed company, cannot share any future performance guidance or any forward-looking statements. Therefore, future results may differ materially from any forward-looking statements made during the call today. Please allow me now to hand over to Mr. Faisal Nassar, our CEO, who will provide a comprehensive and full overview of HMG performance during the second quarter and first half of 2025. After that, we'll be happy to answer and address all of your questions. Mr. Faisal.
Thank you, Ziad, and warm welcome to everyone on today's call. As usual, we'll go through the operational financial performance, the financial performance to be specific, very quickly, and try as much as we can to allow for more time for the Q&A section. So if you start, I'll start from slide number 5, which is the financial performance. During the Q2, we have delivered strong financial and operational growth. This was driven by increased patient volume across both existing facility and also our new launched project. The growth reflects the volume across. The growth reflects I would say, the effectiveness of our patient-focused expansion strategy, supported by as you know, the continued investment in the new healthcare facility infrastructure transformation, which would eventually lead to us reinforcing our market share and leadership. If we go to the revenue, during this quarter, revenue increased by 811 million, almost 31.5% growth. And this is considered to be one of the highest quarter ever achieved to HMG in terms of revenue, reaching 3.4 billion, of course, driven by a strong performance across both the existing operation and the newly launched project. These projects, as you may know, include southwest of Jeddah, Al-Fayha, which we have opened in March 2024, Sahafa, north of Riyadh, which were opened on June 2024, and also Women Health Hospital, mid of October 2024. And during 2025, Al-Hamra, January, Al-Kharj, May, and also north of Jeddah, mid of June 2025. If we look at our gross profits, increased by 188 million, reaching 1.1. Gross profit margin at 31.5% compared to 34.1%. EBITDA increased by 175 million, 25%, reaching 858, with a margin of 25.4 compared to 26.5 in Q2 2024. For the net income, increased by 36 million, 6.5%, reaching 591. Net income margin at 17.5 compared to 21.6. As you know, whether on the gross profit level or net income level, margin were temporarily impacted by the initial fixed operating costs from the recent expansion. As you know, these facilities are experiencing gradual revenue ramp up, and we would expect them to progress over the coming period to achieve optimal operational capacity, anticipated to absorb or to strengthen the cost absorption and improve profitability. If we look at revenue by segment, hospital increased by 693, 35.5%, reaching 2.6 billion, driven by the strong growth in volume as we have opened all of these facilities. Considering that the number of hospitals increased from 9 hospitals in Q2 to 13 in Q2 2025, between 2024 and 2025 of the same period. Pharmacy increased by 28%, 153 million, to reaching 695, supported by the growth in hospital. This is number one, and the continuous expansion effort in this segment. Our pharmacy network expanded from 27 pharmacy in Q2 2024 to 40 pharmacy in Q2 2025. As you know, there is multiple pharmacy in each branch. On the solution side, reached 45 million, representing 1.3% of our group total revenue. Most of the solution during that massive expansion were focused on the business of the hospital. On slide number 6, which is the H1, again, it's a continuation, H1 and Q1 and Q2. Strong financial and operational performance supported by the patient volume growth across both established and newly open facility. This performance reflect continuous progress from the prior period and highlight the impact of our expansion effort. On the revenue side, we increased by 1.4 billion, 28%, reaching 6.5. Of course, the growth is mainly attributed to the contribution of our new hospital opened during the year. Again, Al-Hamra January 25, Al-Kharj end of May, and also Al-Muhammadiyah mid of June. Gross profit increased by 339, plus 19.3% growth, reaching around 2.1. Gross profit margin at 32 compared to 34.5. EBITDA increased by 310, plus 22% growth, reaching 1.7. On the margin side for the EBITDA, stood at 25.6 as compared to 26.8. Net income increased by 42 million, 3.8% on the first half, reaching 1.2, and the net margin is at 17.5 compared to 21. Same what we have mentioned about the quarter. It's the fixed cost of the new project. While these recent expansion have added fixed cost layers, the ongoing ramp up in activities expected, inshallah, to gradually offset margin pressure. On the segment, hospital increased by 1.2 billion, 31.7% growth, reaching 5.1, driven by patient growth, as we mentioned. Pharmacy increased by 265, 24.4%, reaching 1.4, again for similar reason. And solution 113, representing 1.7% of total revenue of the group. If we go to balance sheet, as you can see, and due to the expansion, total assets grew by 29, almost 30%, 29.6%, reaching 22.5 billion, primarily driven by the strategic expansion initiative. Non-current assets represent 74.5% of the total assets, highlighting the group continued focus on long-term infrastructure investment. This sustained investment underscores HMG long-term commitment to scalable and sustainable growth. Cash position, despite the marginal revenue growth, maintained at 2.2 billion. Similar or better position compared to the same period of last year. Cash management and liquidity continue to our efficient management of cash in H1, despite, of course, the increase in working capital needs from the new project. Looking at receivable, remains stable for 42 days. Inventory turnover remains steady at 39 days. Payable slightly increased to 82 days, which is expected due to the extent term linked to the capital expenditure, but still within a normal range as compared to the industry, or even, I would say, in a better range. The cash cycle remained negative as of the same period last year, showing strong working capital efficiency relative to the industry. The current ratio improved to 1.18, stable liquidity level that continue to support HMG operation needs and strategic growth initiative. On the return ratio, continue to have strong financial return, despite the ongoing ramp-up of recent launched facility. These projects are currently, and at the same time, these projects are currently undergoing gradual revenue acceleration and expected to improve to reach optimal operational capacity. The company continue to deliver strong return metrics. Of course, we are outperforming the broader industry average. Return on equity is 32.1%. Return on assets 11.5%. Return on capital employed is 16.2%, which is in all metrics above the industry averages. Leverage. Overall, balanced financial leverage is maintained, of course, to facilitate sustainable growth considering the strategic expansion. Debt to equity ratio stood at 1.1x, which is, I would say, a well-balanced capital structure aligned with our moderate risk profile and growth strategy. Interest coverage remains strong at 7.8%, despite the increase in finance charges previously capitalized and now recognized as period costs, of course, as well as higher debt associated with strategic expansion compared to last year. Nevertheless, this ratio remain good and above industry average, highlighting our solid capacity to meet debt obligation. DSR 8.1x for first half, again strong capability in managing our debt obligation. If we look at our debt in the past 5 years, increased almost by more than 6 billion, investing in, I would say, 12.1 billion in capex. But alhamdulillah, we still within a very healthy range, reflecting our discipline and balance between debt and equity to sustain growth. On slide number 9, which is the dividends, as we always mentioned, our commitment is consistent to provide shareholders with sound return. We have declared dividends of 416.5 million, 70.5% payout, or 1.19 per share. When we believe the dividend consistency highlights financial strength and discipline growth. If we look at the CAGR of growth in terms of dividends over the past 5 years, it's reaching 24.4%. If we go to the project update, just to quickly recap for everyone, these are the projects that we have opened during 2024 and also 2025. Basically, we have successfully, during these 2 years, launched 6 new projects, bringing our total network to 13 hospitals. In 2024, we opened 3, south of Jeddah, Al-Fayha, Sahafa, north of Riyadh, and also Women Health Hospital. In 2025, we've opened also 3 hospitals. Hamra Hospital opened in January, Kharj Hospital opened in May, and Muhammadiyah Hospital north of Jeddah was opened in mid of June 2025. For the future project, looking ahead, we have several projects under development. Talking about the announced ones is the Tabuk. Tabuk Hospital is currently under construction, expected completion end of 2027. This is our first presence in the northern region of the kingdom. We have also recently, as you know, announced the update on Jubail Industrial City Hospital. Construction is expected to start on Q4 2025, anticipating completion to be in Q4 2028. So beginning of Q1 2029, we will start the commissioning of this hospital. As you can see, we have now successfully expanded our capacity to over 3,800 beds. I would say this is almost doubling our capacity, with a few rooms to even increase it over 400 if we want to from the newly opened facility. Now, I think most of what we have mentioned in our whether roadshow or annual report have, alhamdulillah, been opened, and we are looking forward to complete the new ones, and also to share with you whatever new project that we are planning to expanding into. Thank you very much. I would now be happy to receive your question.
Thank you very much. We now open the floor for questions and answers. If you wish to ask a question, you can either send them in the chat or you can use the raise hand function. Until we receive raise hand requests, I'll read a couple of questions we got in the chat. The first one, can we get color on the like-for-like growth and the number of patients and revenue if we were to exclude the recently opened facilities?
Can you repeat? Let me see the question.
Can we get? I'm not sure if you
Let
can
me-
see it or not
لا
because
لا,
it's
I have to see the
you can.
chat. Sorry.
Actually, we didn't see the chat.
Yeah,
but
it's sent directly to me. That's why you can see this
directly
one
to you.
specifically.
Okay. Okay, can you repeat the
Uh,
question?
Of course. Can we get color on the like-for-like growth and the number of patients and revenue? That means if we were to exclude the recently opened facilities.
The growth, and I'll give it to you in a very, I would say, summarized way. 75% of the growth is coming from the new project, and 25% of the growth is coming from the existing project. I think this answers your question.
Yes. The second part, if you can give us the utilization you're operating at as of the second quarter of 25.
Utilization, of course, this is going to be a bit. And if we take the overall utilization, we are reaching 57.5. But this is, of course, as you know, we are adding more and more hospital. But in overall capacity, we are reaching 57.5%.
Great. I've also received questions in the chat. If you can give us an update on the recently opened facilities. So in previous calls, you used to mention, for example, Jeddah is either at or approaching break even. If you're running at all utilization, how has been traffic there? And I think the questions are also mostly focused on the two hospitals that were opened in the second quarter of 25.
For Jeddah, let's talk about for Jeddah. As I mentioned in the previous call, we have already, and I'm talking about southwest of Jeddah, which is we have opened in end of March 2024. Now we are reaching a capacity or utilization of 64%, and we have already achieved EBITDA positive, and also we have achieved as well break even. On the north of Riyadh, open in June 2024. We are now at 33% utilization, and we have already achieved both break even, EBITDA positive, and also we are break even. For Al-Hamra, open in January 2025. We are reaching about 33.6%. And we have already achieved EBITDA positive, but not yet breaking. We're talking about now from opening to now almost 7 months. But I can see the break even very, very, very soon. Women health, now this is, it's like an extension of an existing project we have, and also expanding in the existing one. Now we are at 67% utilization. Already break even from both EBITDA and also profitability. Now for the project open in 2025, except for Al-Hamra, which is north of Jeddah, and north of Jeddah is open mid of June 2025. It's still too early. We need to give it at least 4 to 5 months. And Al-Kharj also opened in May, so we need to give it some time. I think this is as a summary of the 6 hospital opened, whether 2024 or 2025.
Yeah, very clear. Thank you very much. 2 follow-ups on those 2 points. Number 1 is, given the success that you've been able to produce in Jeddah region so far, can we see a 3rd hospital in that area done by Habib?
I don't think so.
Understood. And the last follow-up on the projects is, have you seen any impact on the Southwest Jeddah from the opening of the new North Jeddah in the second quarter of 25?
Very good question. And we are very aware of this. So we have made every effort not to make not to do some sort of cannibalization or competition between the two projects. So Alhamdulillah, we're still growing in both projects. And now since mid of June to mid of July to mid of August, we are experiencing still growth in South. But this was on very, we haven't moved anyone from the South. We've continued to keep a star position in the South. So they will not move their patient, and we're building everything from scratch in the North. As you know, the North has a bit of, I would say, advantage over the South one. We all know this. So we're trying as much as we can not to affect our South projects.
Very clear. We'll take questions from the raise hand function. We'll start with Madhu from Rashi. Please unmute yourself and go ahead. Madhu, you need to unmute from your line as well. And please, a reminder to everyone, limit yourself to 2 questions because we have a long queue ahead of us.
Sure. Thank you, Ahmed. Can you hear me?
Yes, we can.
Okay, thank you. I have 3 questions. One is a follow-up on the utilization rate that you mentioned for North Riyadh. So 33% is on the total 500 beds, or is it only for the beds that you have opened? Because I think in Q1 you had mentioned that you have reached a decent utilization for the ones that you have opened.
Yes. To answer your question, no, this is on the total. But
and
if we
same is the case with Alhambra?
No, Alhambra, we opened it as it's a small hospital, so we have opened it completely, the whole 100 and 100 plus beds. But on Sahafa, no, you have opened, as I mentioned before, started with 30%. Now we have reached, and we have also increased it to 270, and now we're approaching 300 out of the 500. So I'm telling you the utilization on the overall capacity. But if we are looking at the existing, no, we are in the range of 57-60%.
Okay, and what is the plan for North Jeddah and Al Kharj in terms of opening the beds?
It will have to be. We will continue the same strategy. We open the 30%. We see the volume. And in north of Jeddah, I think seeing the daily numbers, I believe we will accelerate. It's obvious. We will definitely accelerate it. Maybe it will be even faster than the south.
Clear.
On Kharj, I think it will be the normal way of frontal.
Okay.
The few numbers that we are seeing is okay, but it's not like north of Jeddah.
Clear. And when it comes to medical centers, can you share more insight, like how many clinics in total you have for all 6 medical centers, and what are the utilization rates? And if you can quantify the revenues in H1 2025 and FY 2024, that would be helpful.
Maybe this one we can reply to you in private, because to be fair, I don't have it in front of me and I don't want to give you. But see, and we're not revealing, center by center or entity-wise revenue, but on the consolidated center, we could. But the number of clinics, this is we don't disclose it.
Okay. Just one more and then I'll come back in the queue.
Do you mind if we keep it to the end, and if we still have time, you answer it? I'm sorry.
No problem. I'll come back.
I'll get you. Yeah, okay. Thank you.
Okay.
We'll move on to questions from the line of Fahad from Sab Invest. Please unmute yourself and go ahead.
Mr. Faisal, congratulations on the impressive results. I have two questions. The first question regarding Southwest Jeddah. How did you see the growth in number of patients there? As we saw multiple players delivered double-digit growth in terms of patients, and can you give us some light? When did the hospital reach the break-even level, during which month, if you can elaborate about this? And my second question is about Sahafa branch. Correct me if I'm wrong. Sahafa reached a break-even point, or not yet, and or at what capacity currently they are utilizing? How many beds currently are operating there? Thank you.
Okay. Let's first talk about south of Jeddah. And in Jeddah, I think we have achieved it towards the end of 2024. I mean, it's a new record, which is almost less than 7 months or 9 months. Sorry. Less than 9 months. Break even followed it within a few months in the Q1 2025. Utilization, as I mentioned, it is it's 65%. Okay, and the project is progressing in I would say, even as the performance of the hospital in Riyadh. Okay, not even less. Considering at the same time it's a new area for us, but I would say that the project is going very well. For the north, I believe in this is I would say maybe it's going to be a bit easier than the south. For Sahafa, I would say similar situation, but this is the situation of Sahafa is the location of Sahafa is very good. An excellent location. We've achieved the break even, yes, within 6 months, and just a few in Q1, end of Q1, we have also achieved the break even in terms of netting. The number of beds, we started with 30% almost, which was around 130, and then we increased it to 270 or to 230, and then now we are approaching 330 or 300 to be specific, 300. As I mentioned, this project is expandable. We were planning to have our head office in the project, but now after seeing the volume, we are not moving to the project, and we would use the head office places in one of the north tower, to future expansion. If we would expand it more, this is going to add from 200 to 300 bed of ward bed. It's for future expansion.
يعطيك العافية و congratulations again.
تسلم.
Thank you. We'll move on to questions from the line of Margarita from GTN. Please unmute yourself and go ahead.
Hi, am I audible?
Yes.
Yeah.
Perfect.
Yes.
Thank you for taking my question. Hi, gentlemen. So my questions are around profitability, really. So we've opened 3 new hospitals in the first half of this year. 3 more facilities opened in 2024. They're ramping up rather quickly. Would it be fair to assume that our margins are only going to recover from now on till Tabuk and Jubail are launched, or do you see any other potential profitability pressure in the next couple of years?
I would agree with you. In terms of hospital, I think the next or the closest one is something like Tabuk and Jubail. But I would not see much more pressure, except from the existing one, which is in the ramp up phase. I agree with you.
Yeah, fair enough. And what kind of targets on the group level are you marking for yourselves, given that the new projects are ramping up much faster than what we've seen historically? Do you see any margin targets or net debt EBITDA targets that we can kind of, have as well?
Our target is to maintain whatever we have achieved before the expansion. This is the target that we are targeting. Of course, now with the expansion, volume and scale will be more. But we'll try as much as we can to be above the targets before. And we can because of the volume.
Yeah.
But at least as a target, we should not be less than what we have achieved before the start of the expansion.
So basically 2023 numbers
Yes.
should be our... Okay,
Yes.
fair. Thank you so much. I'll come back to the queue. Thank you.
Thank you.
Thank you. We'll take questions from the line of Faisal from Alpha Capital. Please unmute yourself and go ahead.
Hi, am I audible?
Yes.
Yes, we can hear you, Faisal.
Assalamu alaikum. يعطيكم العافية. So I have 2 questions from my side. The first one is about the Jeddah region. So despite your ramp up, mashallah, in Jeddah, other operators are currently achieving full utilization there. Does that mean demand is very strong there and potentially no cannibalization will occur between the 2 assets that you have? So that's the first one. The second one is about reimbursement rates between Habib and insurance companies. Is there any difference between your reimbursement rates in Jeddah region compared to Riyadh reimbursement rates, or is it roughly similar?
It's exactly the same. We have a unified kind of an agreement with all insurance companies. So Jeddah, same of Riyadh, same of Khobar. This is to answer your second question. Your first question was, what was the first question? It was about the demand there. Yeah, the demand. Yeah. Maybe Faisal, we are lucky that we've made it while everybody at full capacity, so we can take more volume from them. But again, if you look at others, they are also trying as much as they can to expand, even if from within their facility. Now, the demand in Jeddah, definitely not the same demand in Riyadh, but I would say quality operator is not as much as and complexity is not as much as the ones in Riyadh. Maybe this is what gave us a bit of a competitive advantage when we penetrate Jeddah. But in terms of demand, I can't quantify it, but definitely not like Riyadh when it comes to, because as you know, everything now is being moved to Riyadh.
Wow, very clear. Just a follow up on the reimbursements.
Yeah.
Just to understand. So you enter Jeddah region at lower prices than what's offered there in Jeddah, صح?
Yes. حنا what we have, maybe we are in Jeddah, the prices is higher, but we have chosen not to negotiate prices in Jeddah and having different as with our agreement with the insurance company, keep in mind that we went to Khubar and we used the prices of Riyadh, which is at that time Khubar was way lower than Riyadh. So now it's the other way around. And we had a strategic decision not to match it with Jeddah for so many reasons. And I think, as you can see, the ramp up is a testimony of that strategy. I don't believe that there is any other have ramped up the project on these periods, a shorter period. It's I hope I answered your question.
Very clear. Thank you so much.
Thank you. We'll move on to questions from the line of Mossad from Riyadh Capital. Please unmute yourself and go ahead.
Assalamu alaikum.
Alaikum salam.
Thank you, Mr. Faisal, for the presentation. So I have two questions from my side, and it's mainly in the pharmacy segment. So can you give us your clear strategy in terms of pharmacies? Now what we are seeing that the company are expanding beyond the hospitals in terms of pharmacies. Is there any number that you would like to achieve at the end of this year or the next year? This is my first question. So my second question is also in regard to pharmacies, but in terms of profitability. So pharmacy profitability has shrunk if one to compare first half of 2025 relative to first half of 2024. Is this mainly due to the expansions in terms of pharmacy in hospital, which I believe it was mainly in Feiha Hospital and Sahafa Hospital, or due to the new strategy, which is expanding beyond hospital for the pharmacies, or third, which is mainly competition with other players in pharmacy segment? Thank you.
Okay. For the strategy, we are a big believer for pharmacy. As you can see, we have a couple now of pharmacy that is not within our facility. We have launched our e-pharmacy platform. We are working on a big, I would say, move into the e-pharmacy. One of the enabler of e-pharmacy, of course, is to have limited number of, I would say, distribution point where you open your pharmacy and it's at the same time like a dark store. So we are believing that the e-pharmacy would add more, first, patient experience, in which the patient can, there is no need for him to be in line for his medicine, to take his medicine before leaving the hospital. We are introducing a new feature of where if you don't want to go to the pharmacy, e-pharmacy will deliver your medication at your home. And we are promoting this heavily. We will be promoting this heavily in the coming few months. Targets, and I would say target of pharmacy we are the e-pharmacy is we're targeting more than 10% at least coming from the online orders. The ultimate target is to have a minimum of 20% to 25% growth. 25 to 20%, 20 to 25% of the pharmacy coming from the e-pharmacy. So we're not going to be a retail pharmacy, but we will increase the presence as an enabler for other services to be given to our patient. Profitability, it's two things. One, of course, the opening. Second, new regulation when it comes to branded versus generic. This is number two. But this is going to be balanced, I hope, by the focusing on the online activities. Thank you.
Right. I think. Yeah. Go ahead. Sorry.
Yeah. Just a follow-up. So is there any like numbers that you would like to achieve in terms of the physical pharmacies that you are expanding in?
والله مصعب, we are working on the strategy. I don't want to reveal numbers, but still we are working on it, definitely on future call. Once it's cleared, I will share it with you.
Great. I'll take quickly a couple of questions from the chat, and I'll go back to the raise hand function again. Several questions are on CapEx. Are you able to guide us to CapEx spending in 25, 26, and 27? And also, if you can disclose the CapEx for Tabuk and Jubail.
Okay. As the assets is 2025 2.4, 26 1.9, and 27 1.3. Okay. We have already, I think, spent 1.9 so far in 2025. For the Tabuk and Jubail, it's you mean how? What's the size of the cost of the
yes, construction capex or investment cost for the hospitals to be built?
It's already in the announcement. I mean, okay, for Tabuk, what was the announcement? 460. Oh, 470, and for the newly announced Jubail is 570. But you can refer to the announcement, so you can see it.
Sure, thank you. A question is, can you give us any targets or aspirations on your behalf on price increases going forward, or you will continue with the current strategy, which is to focus on growing volumes and not necessarily touching prices?
See, this is not something that we are not putting on the table. But I think as we are pushing volume and pushing market share, this is not the right time. So we'll not take this path, at least for the coming period, because we are pushing for the volume. However, if in 1 year or so something change, we are not anymore be able to absorb certain costs, definitely it's an option that we will go and negotiate with the payers.
Understood. We'll take questions actually, again, back from the line. We'll take questions from the line of Abdullah Al-Shamsan from Blom Invest. Please unmute yourself and go ahead.
Hello, am I audible?
Yes, Abdullah.
Yes, first, congrats on your results, and thank you for taking my question. Two questions from my side. First, regarding your first hospital, Al-Alaya Hospital, which is becoming or is an old facility. Are you considering renovation for this hospital? And second question regarding Jubail. What exactly the reason behind going there, even in Tabuk? Is it targeting a specific client? Let's say for Jubail, you are considering targeting Sabic or something like that. Just a few color on the two projects.
Okay. For Al-Alaya, of course, it's an old facility. We're continuing to upgrade it. Of course, with the patient being on a daily basis going there, it's not easy. But we'll continue to always try to improve it. Now, almost 90% of the assets in Alaya is not. It's all owned by the group. We're trying now to upgrade the facility. We are now changing the elevators, upgrading the infrastructure. maybe not the building itself because it's an old building, but at least bringing it up to speed with the other facility. We are now also very close to with the municipality to solve the parking issue permanently by building almost 8 to 10, I would say 5 to 6 story parking in our land. Hopefully they will get this. This will solve a huge problem. This project by itself could produce up to 700 parking, which will solve most of the issue during the in the area. For Jubail, as you are rightly mentioned, I mean, Jubail, all petrochem, all cover the client. So we want to always be very close to them. It's a small hospital. It's not a big one. And we believe it will cater for the needs of the market there. Tabuk, we do have belief that we don't have any existent in the north. This is very close to Neo, and we would see that's why we are not accelerating the construction. We want it to be with the opening of certain part of Neo. And we believe that this project will be, inshallah, our increasing our footsteps in northern area.
Very clear. One follow-up question regarding Al-Alaya. Should we expect, let's say, a soft closure or closing of a few beds there, or it will be only renovating a couple of things?
Absolutely not. Absolutely not. No, it's going to be a continuous renovation.
Clear.
يعني
Thank you.
It's a continuous renovation, يعني seizing the opportunity of the low season or during Eid holidays, something like that.
Very clear. Once again, thank you for taking my question and congrats.
Thank you. We'll take questions from the line of Alexander. I can't see your firm entity, so please introduce your firm entity and go ahead with your questions.
Hi, good afternoon, guys. Congrats on the positive set of results. Just a couple from me. The first one is looking at your sort of deleveraging strategy. How do you see your net debt position evolving over the next 5 years? And the second question is, we're seeing almost lots of new entrants come to market, 3 from June to June, with a focus on Riyadh. Do you see that as a threat or a hindrance to your future growth?
Okay. When it comes to debt to equity, will definitely be balanced. We're not going to be leveraging our balance sheet to become a leveraged company. Targets, I would not see ourselves by any means crossing 1.5x. If this, to clarify the point. And I think while we are good in ramp up, this will help in reducing it after reaching the high level. The second one is Riyadh. See, Riyadh now we are determined to always maintain the highest market share, whether through our hospital network or through our medical center. You look at Riyadh now, I would say we are almost 50% market share, 40 to 50. And I don't have the exact number, but I would say from 40 to 45, to be modest, this is our market share in Riyadh. I think we will continue to fight to maintain this. despite the fact that others are coming to penetrate.
Perfect. Thank you. Just to follow up to the first one. So did I understand this correctly? You're aiming to get to around 1.5 times debt to equity over the next 5 years.
Yeah, and I would say this is our ceiling. I'm not able to reach it, but I cannot see myself going over the 1.5.
Thank you very much. Very helpful.
Thank you.
Thank you. We'll move on to questions from the line of Hikmat Salahi from Lazard. Please unmute yourself and go ahead.
Thank you. Hello, am I audible?
Yes, yes.
Okay, thank you, management, for the presentation. I just have one question from my side. Regarding the utilization rate that was mentioned, around 57.5%. So based on my understanding, the utilization rate in 2024 for the full year was around 58%. Now, I understand the drop was due to the major addition that happened in 2024, but my question is for 2025, given the ramp up of the newly opened hospitals in 2024, shouldn't it outweigh the newly added ones? So overall, we should see some sort of improvement.
Let me tell you, and I think in the next call, what we would be doing is to give you the utilization on the operated beds. Maybe this would give you more precise view of the utilization, because now we are saying 57 based on whatever announced number of bed, which is not the utilized one. For your comparison,
capacity.
Yeah, for your comparison to be more accurate, we would be presenting, or maybe you can reach out to the investor relation to see the utilization on total beds and the utilization on operated bed. I think this will give you a very clear idea.
And in 2024, just to follow up, it was below 3,300 more or less. It's safe to assume that it was not 3,300 operated beds in 2024. It was less than that.
Yeah.
In 2024, so we did not introduce into operations the full 1,400. So it was
of course,
below
absolutely, yes.
Okay, so on a like for like, it might be stable to slightly improvement.
Yes.
Okay, clearly. Thank you very much.
Thank you. We're already past the time, but the company has somewhat agreed to take some final questions, so thank you for that. We'll take questions from the line of Alessandra David. Please unmute yourself and go ahead.
Hi, can you hear me?
Yes, we can hear you, Alessandra.
Thank you for taking my question. Just only one from my side. I was just curious on the guidance, so the guidance you've given to return to the 2023 level of margins. How much of this is sort of taking into account, obviously, the uncertainty regarding DRG, or is this just due to the magnitude of the beds you've brought online?
See, I mean, challenges, I would definitely agree. I mean, the whole market is going to transform during the coming period, but we're going to have to eventually have a target and objective as a management team. So the target is to always maintain. I mean, and we will do whatever it takes, even with the conversion from fee-for-service to the DRG, to maintain. Challenges along the way, yes. It depends on what the regulator would do, how he will take the implementation. Is it going to be over a short period of time, long period of time? At least, and is the regulator will be pushing it to the limit? From what I have seen, at least, on the preparation for it, I think the regulator will be much more, will learn from the mistake that happens on the nearby country, and they will be more reasonable, especially on the time, because this is a big change, whether to provider and payer, and hope that on the pricing and national baseline, it will be something reasonable. These are all moving factors. I mean, you cannot produce an estimate on factors that is not within your control. But I hope that these are going to happen, and based on that, happening, this is our target, to maintain the previous.
No, that makes sense. I think I was just sort of referring specifically to your target to return to the 2023 level of EBITDA margin. I think I was just curious if, I think the previous guidance you've given is around sort of 1H26. So correct me if that's changed, obviously, given that you've exceeded all your break-even targets. But I was just curious with maybe the disconnect between the two of that, if that was sort of factoring in any uncertainty from DRG or a pricing that might not be sort of business as usual.
I think you rightly mentioned it. This is factoring the uncertainty of the change of the whole reimbursement structure.
Thank you.
Thank you.
Thank you. We'll take 2 follow-ups, and then supposedly we're going to be done. Madhu, if you have follow-ups again, please unmute yourself and go ahead.
Thank you, Ahmed, for the opportunity again. Yes, I have 3 questions. One is related to the cost. If I look at the number of doctors that you have now compared to what you had in 2023, doctors to beds ratio is, when it comes to when if we adjust for the beds that you have opened, it's in line with what you had at the peak level, which is 2.2 doctors per bed. Same is the case with cost of sales. If we adjust for the number of beds that you have opened, you have already reached the level which you were at the peak level in 2023, and the depreciation has also doubled as your assets have doubled. So does that mean the cost base in H1 includes all the front-loaded cost, which includes the hiring of doctors, keeping in mind the expected ramp up? If that is the case, can we assume that the annualized cost base is, would grow marginally in 2026, whereas the revenue growth will pick up, and that will result in substantial improvement in margin? So my question is related to bottoming out of the margins. Have we already reached a level where we would see minimal increase in cost of sales but substantial increase in sales? So that is question number 1. Second, on capex, you're expecting 1.9 billion next year and 1.3 in 2027, so that is 3 billion. You have plans to spend 1 billion for Tabuk and Jubail. What is driving the additional capex, and what is the reason for such high capex, as most of your facilities are new and you have already opened it? So that's on capex. Third, on growth strategy, I remember sometime in 2023 you had mentioned that you have plans to tap class B patients as well. So any update on that? And in case you decide to increase the pricing for insurance, what sort of price hikes one should assume? So these are 3 questions.
Well, this is maybe 5 questions embedded into 3, but it's okay. For question number 1, definitely we have not. I just want to remind you of something, which is the 2 newly opened hospital. Still, you haven't seen. We haven't started to expense because this was very, very, very close. So you expect 2 more on depreciation and more into interest expenses. That's why your calculation has not, because we have not peaked yet. You haven't seen the peak of the addition of assets. Once you see the peak, then you can do the same calculation and expect when the margin will improve. And I would say 2026 is going to be of course, it depends on our ramp up, but it is going to be not an easy year. Starting from 2027, going forward, I would say we will see an improved, over-improved back again in terms of margin. But if you now look at the effect of the new hospital, excluding these two, which is Kharj and north of Jeddah, we are still, I mean, we're still better than what we have anticipated by big time. So I would advise you to look at it when we peaked in terms of interest and depreciation. Additional capex, yes, we are having two projects, but again, the existing facility needs a lot of renovation, maintenance. We do have Rayyan. It's been now almost 15 years since we opened it. We do have Takhassusi. It's now 13 years since we have opened it. The newly opened hospital in 2019, which is Khubar, needs a lot of improvement as well. So this is very high footstep, crowded hospital that you need to from every I would say 4 to 5 years you need a major renovation and maintenance for them. This is number 2. Number 3 is the also our expansion in medical center. Class B patient, yes, through the medical center we are now we are focusing on them, not on the hospital, but on the medical center, and through special structure deal with the insurance, we can refer them to our hospital if they needed an hospitalization. A price hike, to be fair, we haven't thought about it. I don't think that this is the right time. I don't have a magnitude of how and by how much we will increase the price. I think this is very early to talk about it. On a strategy level, I think we will continue on the volume, pushing the market share, and I don't see it coming during this year.
Understood. We'll take our final questions from Fahad from Sab Invest, and afterwards you can proceed with any concluding remarks you have. Fahad, please go ahead. Fahad, we're not able to hear you. Wait, let me. So I've muted you. Let me unmute you 1 second. Yes, try now to unmute yourself.
Assalamu alaikum. I am audible.
Yes, you are now. Go ahead.
Mr. Faisal, I have 2 questions. The first question regarding again Southwest Jeddah. You mentioned that it reached net break even Q1 2025, and it is you own only 50%, and the other 50% is owned by Al-Andalus. So
Yes.
if we see Al-Andalus investments in associate on a Q-over-Q basis, there is an increase in losses by almost 2 million. So can you please elaborate what is the agreement in terms of management fees? Is it from the revenue or it is from net profit or operating profit? And my second question is regarding Aliyah Hospital. What is the overall numbers and performance in terms of Aliyah Hospital, in terms of utilization, patient traffic? Is there growth in the patients' visits there?
Okay, let me answer you about Aliyah. When it comes to hospitalization, it's very high. It's almost reaching 75% on average. Maternity hospital it's only an 80 bed, which is almost fully utilized. On your second question, which is on the other 50%, keep in mind, then and yeah, hi. For
Yes.
Gharb Jeddah, if you recall, Gharb Jeddah was launched at the end of March 2024. That means the impact related for the first half is only limited to the first 3 months and the second quarter. Compared to 2025, you have Q1 fully operated and the second Q, which is also fully operated. Having the additional cost and the interest, this is why it's not apple-to-apple comparison.
But I'm comparing it on a Q-over-Q basis. Yani Q1 with Q2.
Yeah, but the Q2 is still the impact of depreciation and capitalization and the other matter still not yet in place.
Yeah. So
Yeah, let me tell you, it doesn't mean that we operated the hospital, the capitalization and the interest start immediately. But we take time until we call it soft opening, testing, commissioning, at least for the first 3 months, 2 to 3 months. But there is still capitalization and interest capitalization and no depreciation during this period. There is a process for it where you start to count the assets, tag them, and capitalize them. It takes a minimum of 3 months.
we should assume management fees net income, not revenues.
The management fee is to the top line, which has nothing to do with what we have discussed. لا أنا أتكلم المانجمنت fees on the revenue different. يعني أنت if you need a specific أنت you have something which is not tallying, right? You have something that you need to know in specific. Please,
Inshallah.
Be our guest. Send an email with full details of your question. We will do an analysis for you, like to like, between the quarters, so you can understand.
Okay, inshallah, I'll reach out to Mr. Ziyad, inshallah. Okay. يعطيك العافية وشكرا لك.
We're done with everything. We're already crossed the 1 hour mark. So thank you very much for extending, and I'll pass it back if you have any concluding remarks.
Thank you everyone. Please feel free to reach out, to send an email to our investor relation, and we will make sure that every question that you will be requesting answered in a very short period. Thank you everyone for being in our call.
Thank you.
Thank you very much to HMG's management and to all participants. This concludes today's earnings call. Have a good rest of the day, everyone.